Hello, everyone, and welcome to this webinar on emerging markets credit strategy. I am Regis Chatellier, head of EM sovereign strategy at CreditSights. I am joined today with two excellent strategists, Zerlina Zeng, head of Asia Pacific Credit Research, and Erick Vega, senior analyst responsible for EM corporate strategy. I would like to take this opportunity to welcome Erick, who now covers EM corporates and is significantly expanding CreditSights coverage in this area. Now, if you have any questions, feel free to submit them online during the webinar. We will answer them as soon as we can, otherwise individually after the webinar. With that, we'll begin the webinar with questions for Zerlina on China. China is always a big topic. Now, Zerlina, how do you see the growth and inflation outlook, and to what extent the Chinese authority are likely to deliver additional stimulus?
Yeah, thanks, Regis. And very excited to be at our first EM strategy webinar. Moving on to China, China's growth is still unbalanced with weak domestic growth, but offset by very robust exports. In May, both retail sales and fixed asset investment contracted for the first time since COVID lockdowns in 2020. The soft retail sales were attributable to the fade out of the government subsidies, including white goods trading programs. While at the same time, the property downturn, as everybody knows, and the very tight local government budgets continue to weigh on investment. Domestic economy is likely growing at only 1 to 2% in the second quarter. But at the same time, May exports continue surprising to the upside, growing by close to 20%, fueling industrial growth. So we expect these trends to continue into the second half of the year, and we expect full-year growth at 4.7%, which is slightly above market consensus of 4.5%, but this is in line with the government's guidance. Higher, which we don't expect the government to miss, because 2026 is really the first year of the new 5-year planning. Now, onto the inflation. Higher energy prices were actually a blessing in disguise for China, with CPI and PPI both turning positive to 1.2% and 3.9% in May. We expect PPI to peak over the next couple of months and then stabilize as oil prices have come down, and CPI to hover at current levels as the pass-through is very limited because of the weak domestic demand and regulatory controls. For the policy stimulus, I think policymakers are seemingly quite willing to be fairly patient on fiscal stimulus. Recent policy communications from both the Ministry of Finance and PBOC emphasized a more price-based monetary policy framework and also more market-based fiscal stimulus deployment. They promoted rule-based capital account opening and trying to reduce emphasis on aggregate credit extension. And I think something interesting to note and of particular interest for offshore investors is regulators have ramped up their efforts to push RMB internationalization by setting up direct RMB repo lines with the foreign central banks and sovereign wealth funds to provide RMB liquidity and facilitate the allocation by these foreign institutions into RMB. So very interesting trend spotted for offshore investors. Overall, we expect a moderate appreciation of the RMB against both the US dollar and the regional trade partners because of this macro backdrop and the regulatory measures.
Yeah, thank you, Zerlina. That's obviously very insightful, given that China is always the sort of power engine for the rest of EM and the appeal for the sort of export from other EM into China. So I guess there is some stimulus, but still sort of cautious, so moderate stimulus, I would say, for EM. Now, more broadly speaking, will emerging economies remain resilient in the context of persistent uncertainty? I guess I can probably answer that question. First, I would say that emerging markets experience a meaningful economic slowdown as a result of the war in Iran and the closure of the Strait of Hormuz. EM GDP ex China grew by 3.2% year on year in the first quarter of this year. That's a pretty clear slowdown versus the previous quarter. That was at 3.9, so close to 4%. So there's a pretty sharp slowdown. The deceleration was particularly marked in the Middle East for obvious reasons, but also it was pretty marked slowdown in Turkey, given the reliance of Turkey on energy imports. The shock was also significant in several countries, particularly Romania, Chile, Mexico, and Philippines are quite affected by the situation. Although the weaker momentum in these countries was also compounded by domestic factors. In fact, we think the softening in activity will become even more evident in the second quarter, as we gotta see some data coming to be published, given the fact that higher energy prices spread through more fully during that period. Now, in terms of inflation, the impact was even more pronounced, especially in Asia countries. We just mentioned Philippines. Philippines was hardly hit, but was hit pretty badly by inflation, reaching nearly 7%. Pakistan as well, as they import a lot of energy. The impact is quite strong in Egypt, South Africa. In Latin America and Eastern Europe, the rising inflation has been more moderate since the start of the year. But I would say inflation in both regions was already relatively high before the conflict, so I can't say the situation was some sort of sweet spot. Going forward, though, although the conflict with Iran is far from being resolved, and we see that as we turn on TV or internet, we have recurrent attacks from Iran on cargo vessels, and also renewed U.S. strikes on Iranian installations. Then clearly the situation is not set up just or fully resolved, but we still had a pretty significant decline in oil prices. That suggests that inflationary pressure could gradually moderate. Inflation will probably stay higher than long-term average, probably much higher than central banks' targets, but the peak is probably behind us in most EM. Economic activity is also expected to recover after that. GDP growth is expected to rebound to 4.8%. So it's a pretty strong rebound for next year. That's widening the gap with the US. Just for reference, US is expected to grow by 2.2% also next year, Eurozone 1.2%. So clearly EM is still doing fine. Now, in terms of fundamentals, we have some concerns. External trade could still be weaker overall because you have U.S. sectoral tariffs that remain in place. You have obviously the war in Middle East, and that has driven energy prices on the upside, affecting also exports, and also incidentally, Donald Trump decisions to keep the US-MCA trade agreement between Canada, Mexico, and US on annual review that leaves a lot of uncertainty, especially for Mexico for obvious reasons. Now, last bit I would like to mention is fiscal discipline. Away from China and some key countries, fiscal discipline has been more strict in EM than developed markets, but fiscal deficit is still relatively wide, and that reflects elevated debt servicing costs. So on balance, I would say EM fundamentals remain decent, especially in terms of growth prospects, but we still have some weaknesses, and especially in the fiscal side, fiscal deficits are relatively wide still. And in this context, I would expect rating upgrades to be, there will be less rating upgrades than in the past 3 years. I've seen a pretty nice stream of upgrades, but I think that period is probably over. Only selected countries will be probably updated at this point. Now, moving to the EM corporate space, and that's a question for Erick. Are credit fundamental still resilient, or have they been affected by geopolitical uncertainties, energy shocks, and or slowing growth, global growth? Erick?
Hello, Regis. Happy to be part of this panel and this webinar. And my short answer is that fundamentals appear to still be solid at the index level, but I think that the direction of travel has clearly shifted. For much of the last decade, the story in EMIG corporates has been an up in quality re-rating, and I think that story is now running its course. If you look at the EMUB investment grade composite, which tracks USD denominated corporate bonds, we went from a triple B plus equivalent back in 2014 to a solid single A minus by 2024. And that's nearly a full notch of improvement, which is meaningful, but it's been flat at single A minus for about 2 years now. And then when you dig into what actually drove that improvement, I think a lot of it was compositional. First, Russia came out of the index in 2022. Chinese corporates have run net negative issuance for years, and the weaker names have migrated out of IG into high yield. So the average rose largely, I would say, because the mix changed, and the median emerging markets IG borrower didn't really get dramatically stronger, which I think you also see that clearly when you split the index by the rating bucket. Single A rated issuers genuinely improved, though. Par weighted net leverage went from about 2.5 times in 2014 to below 1 times today. But triple Bs, which are 45% of IG weight, uh, saw no comparable improvement. Their net leverage has been stuck in a 2 to 2.5 times range for a decade, and interest coverage has actually eroded, as I think everyone understands, because rates reset higher and the interest bill went up, right? So you have triple Bs running flat fundamentals into a meaningfully higher for longer rate environment, which I believe adds pressure to fundamentals. And it's really worth flagging how much of the composite improvement was really about mix shift rather than issuer level changes. Now, for instance, single A tier grew from about 25% of IG par to nearly 40%. Double A's grew modestly too. But then triple B's shrank from 60% down to about 45% of the index weight. So mechanically, the average had to move up. But if you strip that mix effect out and look at triple Bs on their own, which is nearly half the index, the picture is less flattering with the same leverage and weaker coverage. And I think that the clearest signal that fundamentals have inflected is the ratings migration data that we've seen. Last summer, net par weighted migration in the EMUB index was firmly positive, upgrade led, on the order of tens of billions of dollars. And over the last 3 months, that flipped to net downgrades. And the recent flow is being dominated by triple B fallen angel pressure, roughly 9 times as much as triple B par downgraded as upgraded, concentrated in the low triple B bucket. So I think the momentum on ratings is sure negative. And then onto the sector side, some of them are holding up well. For instance, LATAM basic industry is a good example. The commodity rally has been supportive there. Codelco cut net leverage to the low three, some stronger copper. SQM leverage is down on the lithium recovery. Southern Copper and Vales sit inside 1 times net leverage, and Suzano is delivering into its 2 to 3 times target range. And so I think these are genuinely constructive stories. Latin consumer goods is also stable with Coca-Cola FEMSA, Gruma, and FEMSA all running roughly 1 to 1.5 times net leverage, JBS in the mid twos. So conservative balance sheets across the group. And then in the Gulf, Aramco and ADNOC are structurally supported by the sovereigns. The midstream pipeline holdcos have fixed tariff contracted cash flows that insulate them from commodity price moves to a degree. So the strong parts of the market, I believe, are still genuinely strong. But that said, the strong sectors are not cheap. Basic industry as the richest sector in LATAM on our Z-score work. Consumer goods is the least rich, but it still trades tight. And the Gulf, Aramco, and ADNOC have already retraced most of their conflict-driven widening. So I would say that fundamentals appear supportive, but valuations don't leave you much room to be paid for holding them. And the gap between fundamentals and valuation shows up a lot in the strong parts of the market. Then in the softer spots, I believe many are getting softer. An example would be Raisin, which was a very big story. Went from triple B minus to triple C in a single move back in February. Bonds dropped to around 50 cents, and the company is undergoing a reorg. That's roughly $5 billion of par that left IG in pretty much one shot. Mexico is another pressure point. The sovereign got cut to Ba3 by Moody's. This also pulled Eagle funding down with it because it's sovereign linked. Just spending a little bit more time on Mexico, I think it's worth doing because it's really the biggest single country risk in LATAM. It's 45% of the country risk in utilities, over 50% in consumer goods, and dominates energy through Eagle funding. The offset is that names like Coca-Cola, Gruma, and Bimbo all have very significant not Mexico revenue. So that's credit story isn't purely a Mexico story for those, but when you look at MexCat, Eagle funding, those are sovereign links, so they move very closely in lockstep with the Mexican sovereign. Base case, if Mexico stabilizes, fine, but if it deteriorates further, that's, I think, a significant downside risk to some of these LATAM IG sectors in the second half of the year. So really to bring it together, I think geopolitics, energy shocks, higher for longer rates, and none of those have really broken EMIG fundamentals at the index level. Quality is still historically high, but the tailwinds, I think, that got us here have played out, and the marginal direction has turned negative. And I think a lot of the composite stability we're now seeing also reflects an element of survivorship effect. So I think the average is holding because the weakest names have migrated out, like Raizen, also Braskem, also Televisa, and that triple B rated group is still nearly half of the index and has less cushion, I think, against another leg of downgrades. And so that's, I believe, the fundamental risk we're carrying into the second half.
Thanks, Eric. Pretty insightful for EM corporate fundamentals and how this is reflected in markets somehow. Now, more specifically in EM Asia, that's a question for Zerlina. Are corporates still performing well, or are they facing new challenges? Are export prospects still reasonably strong? I would link this to a question that is from the audience. I mean, what are the main tail risk or the main risk, potentially facing market in Asia high yield markets? If you can wrap up something, Zerlina?
Yeah, sure. So similar to some of the pockets that Eric has observed in EMX Asia space, the credit fundamentals of Asian corporates remain broadly stable to improving with leverage matrix, EBITDA margin, interest coverage, and cash balance, or staying above historical means for IG rating buckets and some of the double B high yield buckets. Downstream sectors such as petrochemical and metal sectors, some of the power generation companies have been challenged by higher energy prices, especially if the market does not have a very efficient or complete cost pass-through. This will likely be reflected in the next 1 to 2 quarterly earnings. That said, I think one of the biggest strengths of the Asia corporates, particularly also for the high yield corporates, is the corporate funding conditions in the Asian local currency loans and bond markets has been very strong, thanks to regulators' proactive liquidity support measures, some of the currency defense tools, and relatively prudent monetary policies. Most of the utilities and large downstream players are state-owned enterprises with very robust implicit government support. So for these guys, they don't really have any issues for funding access, and a lot of the Asian investors and global investors would see them as a very defensive hold given the very strong government backstopping. The recent drop in oil prices and the government's liberal use of energy inventories and energy subsidies, we think are going to keep inflation relatively under control and take some pressure off additional monetary tightening need. Then at the same time, the ongoing AI boom and global tech spending, they still remain a very powerful engine for Asian exporters in the AI supply chain. So other than China, we just mentioned, Korea, Taiwan, Malaysia, and Singapore have each run goods trade surpluses well in excess of 10% of GDP over the past 3 months. And at the same time, the Asian equities are doing very strong. Some of the markets in Korea and Taiwan, despite some recent corrections, have been up like closed more than 100% of the past 12 months. So these equities have eased local financial conditions significantly despite some monetary tightening in selected markets. And this also supported a very big wealth creation and pricing and a lot of consumer spending. But even though we think going ahead, the equity volatility might increase. And I think this is one risk I would say is the biggest risk for the Asia high yield bond market, because compared to Asia IG and some of the global IG market, Asia high yield is very susceptible to global risk sentiment. Whenever we see a risk sentiment retreat, typically some of the relatively high beta Asia high yield names will widen out, even though on a corporate fundamental basis or in terms of the refinancing risk, I think overall it's still under control. Over the past couple of years, a lot of situational names, the situation has been worked out, and so far we don't really have any like very large specialist names that might have some credit contagion risk in the region. So I would say the pullback of local, the global risk sentiment, and at the same time, if there is any additional volatility in terms of local funding conditions, if local rates suddenly shoot higher because of the war is back on the table again and inflation is very high and central bank needs to tighten, then liquidity will become a concern. So overall, I think we are still cautiously optimistic for the Asia high yield bond market, just given the high yield default rate has been largely under control after the past couple of years.
Thanks, Zerlina. We have another question from the audience. So how do you view EM prospect with the strengthening dollar? Would this be a headwind as it is typically for EM? I can start answering this. Obviously, yeah, typically higher dollar is a problem for EM. Mechanically, you have it have an impact on reserves and debt ratios and so forth, and obviously also competitiveness, for EM exports. Now, I think it's probably less vulnerable than in the past globally. There's several reasons for that. I think. Of course, you have FX reserve being a bit under pressure recently, but the level of reserve overall is still okay, and that's a critical buffer for EM. And the second aspect I would mention is that you have increasing diversification of funding, especially in euro, so a bit less reliance on the dollar markets, and we see that in EM and sovereigns tapping the euro market quite extensively. And I think this is a strategy that makes sense to be less reliant on dollar. Now, I guess also in Asia, and I'm sure Zerlina can say a bit more about that, the fact that Asia has a lot of reserves and also have an efficient domestic market can provide some buffer. An important thing also is the fact that we have, as opposed to in the past, we have flexible exchange rates pretty much across the board, and that protects naturally FX reserves. So before, when you had this kind of selling pressure and the high dollar, rising fast, that was a big problem immediately reflected in markets. Do you want to add something, Zerlina, on that, on the dollar strengths and potential impact in Asia?
Yeah, I think we need to look at different markets differently. For instance, in Indonesia, the rupiah has been depreciating against the dollar, and indeed, for a lot of credit investors, this is a concern because it's a reflection of the macro fundamentals. It's a reflection of the government policy, the difficulties to sustain growth, but at the same time, trying to maintain fiscal discipline and defend the currency. It just looks like an impossible task. And because of that, investors has been de-risking Indonesia. And for some of the Southeast Asian markets, FX depreciation also always brings back the nightmare of Asian financial crisis. So credit investors are also a bit wary about that. For India, for instance, India rupee has also been depreciating quite a bit over the past couple of months against the US dollar, but the central bank has come out with very proactive currency defending measures, including attracting a lot of capital inflow into the market by hiking the USD deposit rate on the onshore market. They are also subsidizing for Indian banks, both commercial and policy banks, to go offshore markets to issue dollar bonds. So now the risk for India for the credit investor is really a supply issue. We're seeing like the very high grade Indian banks and NBFI sold off 20, 30 basis point of the couple of months. It's more of a technical concern. Then on the other side, yes, Korean won has also depreciated quite a lot, but this is more of an equity story on the back because a lot of foreign investors are trying to rebalancing their Korean Kospi position. And because of that, they're also selling some Korean won, but it's not a reflection of a general macro or credit fundamentals of a lot of Korean corporates. So I think we do need to look at markets very differently. And as we just said, a lot of Asian corporates are trying to diversify funding away from USD. They do a lot of Asian local currency. So the linkage between the dollar strengthening and dollar funding stress now is much weaker compared with a decade ago.
Thanks, Zerlina. Now we're gonna go into much more into credit markets prospects and how much is priced in at this point. I'm gonna briefly recap what our U.S. Team is thinks about U.S. rates. The team in New York thinks that the Fed is going to hold rates until year end and potentially until the first half of the 2027. They see 10-year Treasury finishing the year at 3.3, 3.4%. That's down from approximately 4.6% at present. Now, in this context, with spreads valuation across credit markets, where they are, what are the prospects for EM sovereigns and both IG and high yield to outperform this year? I would say spreads valuations are very tight. I mean, this is pretty clear. The offer carry from the yield perspective, the average yield is around 6.1% across EM sovereigns, and that's relatively high by historical standards. But and they have plenty of liquidity, and that explains why valuations are tight. But risk premium obviously are very, very, very tight. Spreads are basically decoupled from global financial conditions, and if you look based on historical patterns or relationships, investors are effectively pricing the EM sovereign credit market as a BBB plus asset class, which is basically 2 notches above the current rating. So that's probably overdone. So that's beyond, I would say, markets or from market conditions. But market conditions tell you if you stick to this, would say that spreads should be higher at this point. Now, in terms of sovereign IG in EM, we keep it as underweight at this point. EMIG have posted a pretty modest return so far this year, 0.2%. Spreads have remained pretty much unchanged. Now, the conflict in Iran has had spillover effects across Middle East, especially GCC countries, effectively affected by lower oil and gas exports. But GCC countries account for roughly 1/3 of the EM sovereign IG index. But even so, EM sovereign IG bonds trade at an average spread of 80 basis points or so. That's the tightest level since 2007. And at these levels, future performance will probably depend heavily on the moves of US Treasuries, and that leaves very little scope for excess returns. As far as sovereign high yield are concerned, we also have it as an underperform. EM sovereign bonds have performed a bit better, I would say around 4% year to date, which is not bad, and spreads have tightened by 40 basis points. The asset classes outperform also US high yield corporates that return approximately 2%. But again, the same situation as sovereign high G, valuations are very, very tight. They trade an average spread of 260 basis points or so versus treasuries. That's the tightest level in 20 years. That offer a very limited caution against downside risk. And we view the risk reward profile quite unattractive, despite the fact that fundamentals are not so bad after all, especially in terms of growth prospects for sovereign. In this context, I would expect EM high yield IG spread differential to widen to around 300 basis points over the coming 12 months. and that's from 180 basis points currently. It's very, very tight. Now, in the IG corporate space, Eric, do you think investors are being adequately compensated for the risk? Which sectors do you look most attractive at this point?
Yeah, that's a good question. And short answer, no, I don't think investors are being adequately compensated in EMIG corporates right now. And that's really the basis for our underweight call for the second half. So just laying out the numbers, EMIG corporate is trading at an option adjusted spread of around 80 bips, USIG at about 75 bips, near that 20-year tight mark. So EMIG is sitting at about 5 basis points at a premium to USIG. And through 2025 and the first part of this year, that premium averaged closer to 10 basis points. And our fair value range is 10 to 15 basis points. So we're still inside a historical equilibrium. At a moment, I think the fundamental trajectory is turning negative and technicals are decelerating. We're also basically at yield parity with EMIG yield to worst at around 5.3%, same as USIG. And that's really a function of the EM index's roughly 50% APAC and quality skew. And it's a shorter duration, which has stripped EMIG of its traditional carry cushion over USIG corporates. And in the year, EMIG corporates have generated lower exits and total returns than USIG. So even with spreads tighter, EM has underperformed on both measures. And I think the technical piece really matters here because it's what's been holding spreads so tight. Flows are still positive, but momentum is fading. I believe April was the peak with over $16 billion in monthly inflows. May was $7.5 billion. June was $6 billion net. And that's roughly a 60% deceleration in just 2 months. And if you strip out the March through April Hormuz reversal noise, which largely netted out, year-to-date inflows are running at roughly half the same period last year. Meanwhile, USIG has taken in nearly 3 times last year's pace of net inflows. So what I would say is EM corporates have richened against USIG on materially less demand, and that setup, I think, tends to unwind when inflows normalize. Then the other piece is that the buyer base has narrowed. So June inflows were overwhelmingly Asia-led. Global EM and LATAM contributions were basically flat. So I think that the bid holding spreads tight is getting a bit more concentrated and more price sensitive. And if that Asia bid pauses or even just gets more disciplined on entry levels, then the premium has room to reset back toward that 10 to 15 basis point range. The supply side also supports the same picture. But with some regional dispersion, we want to flag. So APAC running sharply negative net supply. The Gulf is kind of the opposite, $27 billion net positive issuance. We've observed year to date running well ahead of maturities. LATAM has been modestly positive, net positive of $10 billion. So the shrinking APAC float is helping hold the index tight, but the marginal issuance is coming from a region where I think valuations have already retraced. And that's not a supportive setup for adding more risk. So our base case is that the USIG corporates do the spreads widening work, year-end USIG target being 85 basis points versus 75 bips today. And then EMIG largely tracking it with a modest premium normalization on top of that. So that underweight reflects basically our benign reset call. But then on turning to strategy for investors with EM mandates, we tend to like the very short front end of the curve for carry, plus the 5 to 10 year part of the curve for the price tailwind. If long end yields hold in as we expect, then we're underweight the belly 2 to 5 year, where the carry per unit of duration appears to be the weakest. We also like to move up in quality. I think double ace, single ace screen relatively cheap on our Z-score work, and the defensive profile there fits our view that spreads drift wider. Then triple Bs still offer the most carry per unit of duration, but they also screen rich on our Z-score screen. And that's also where the fallen angel risk sits. So we'd avoid a blanket triple B tilt and pick spots by name. Since our house view is the Fed on hold through year end, that matters for how one positions, obviously. if the markets want hike pricing phase toward our hold view, then the 5 to 10 year part of the curve probably gets a price tailwind. It's also why we don't want to be in the belly. I think the 2 to 5 year bucket has taken the most damage year to date in the bear flattener, and it offers the weakest carry per unit of duration going forward. So this barbell is designed to work in the base case and give you some optionality if rates move. Then on sectors, in LATAM, our one outperform is consumer goods. We think it's fundamentally solid. JBS and Coca-Cola FEMSA together are over 50% of the sector weight, both with conservative balance sheets, both geographically diversified enough that Mexico sovereign volatility doesn't dominate the credit story at either. And it screens the least rich of any of our LATAM sectors in our 3-year Z-score. Essentially, you have stable fundamentals, which is the setup that we want. And then on the underperformed side, LATAM transportation is where we're most cautious. Half the sectors, Mexico City Airport Trust and Document, both are sovereign linked, with sovereigns facing negative outlooks by some rating agencies. Then you have Mexcat with Mexico, Document with Panama, and the sector already trades sides. So I think there's very little cushion if either sovereign reprices wider. Then basic industry and energy in LATAM are both holding at market perform. Basics has, I think, the best fundamentals in the region. I think the commodity rally right now is doing the work, but valuations also screen as the richest sector in LATAM. On a straight Z-score screen alone, that would argue for an underperform, but the sector's low beta and the constructive bottom-up view on Vale, Suzano, and SQM, which are roughly a third of the sector weight, are on outperform. And that really holds as at market perform at the sector level. And then on energy, I would say post Raizen is a higher quality composite, now dominated by Eagle funding and an app, but Mexico overhang there naturally caps the upside. And so just spending a little bit more time on energy, I think it's worth doing because the composition change really matters. Before Raizen dropped off, the sector had a much higher beta profile. Raizen alone was about 20% of the sector, and it was the highest beta, most refinancing exposed name. It's now out. What's left there is dominated by Eagle funding at around 60%, which is Mexico sovereign linked. So the residual group of companies there is essentially sovereign linked or contracted and lower beta than before. And so on our first pass, the sector screen somewhat rich, but that was with Raizen. With current constituents alone, we think that this sector is more fairly valued, and that's why it's market perform. In CEMEA, I think we're holding both energy and banking at market perform. The Gulf oil majors, Aramco, ADNOC, Qatar Energy are fundamentally strong and it's sovereign anchored. Qatar Energy took some LNG infrastructure damage earlier in the Iran conflicts, but then they came into it from a very strong balance sheet position. Then on banking, some of the GCC names have absorbed the conflict better than expected. I think valuations there have already retraced most of the widening we saw earlier in the year. So we're not chasing there. So I think bottom line, we don't think investors are essentially being paid enough for the risk at current spread levels. So we stay underweight on EMIG corporates, move up in quality, barbell the curve, and be selective by sector.
Thanks, Erick. We have also some questions about Asia. And so do you expect, Zerlina, further inflows into Asian dollar bond markets, or do you think demand is likely to shift towards local bonds? I mean, you touched upon this subject already. And there is also an additional question. If you can say some few words about Chinese property developers and the change in credit structuring, what does it look like there?
Yeah, sure. In terms of the fund flow into the Asia dollar bond market, if we just look at EPFR data, it has actually showed persistent fund outflow from the market. But I think this could be quite misleading because they only capture a small percentage of the market. And this market is really dominated by undocumented flows from regional insurance, bank treasuries, pension funds, and wealth. Based on our observation and conversation with investors and market participants in Asia dollar credits, the inflow has been significant and has been primarily driven by Chinese money. So the Chinese government has widened some of the official beneficial channels for cross-border financial investment, as onshore liquidity remains excessive and fixed income returns in the onshore market are also very poor. Some of the onshore fixed income managers told us it's also difficult. It's almost difficult to get a 3% of that type of total return. So these fund flows are the reasons behind the extremely tight spreads of China, Korea corporates, and to some extent as well as Japan and Australian banks. While this inflow is partially offset by capital repatriation of Korean and Taiwanese institutional and retail investors from their offshore fixed income investments to onshore equities, given the very strong performance of these local equity markets over the past 12 months. I think two shifts of regional money investment allocations we think are worth highlighting. The first one is, as Regis mentioned, a continued diversification outside the region. So I would say the most crowded spaces right now are European banks and US IG corporates and some of the US MBS. And more regional investors are also looking into ex-Asia EM sovereigns and corporates, with Middle East being the favorite market before the war, and LATAM is probably the favorite of everybody post the war. The second trend we observed is this increased allocation by Asian investors to Asian local currency bond markets that we have just talked about. The reason is really they're a little bit concerned about the structural deterioration of the dollar. Among all the Asian local currency bond markets, AUD is the market receiving the most inflow thanks to its DM status, very strong overall credit rating, short duration, and strong presence of floaters for investors who are a bit cautious about rates risks. And there is also an increasing amount of IG corporate hybrids from the defensive European and US utility names and onshore utility infrastructures names, and these ones offer pretty good spread pickup. And I think if we look at the market compared to when we started recommending investors with dollar mandates to do some diversification into AUD bond, the spreads have indeed tightened a lot alongside with the global IG credit, and the curve has deepened quite a bit, has flattened quite a bit as well. But we still see good relative value against Asia and DM IGPS, given the asset swap basis is still trading outside most of the global IG peers. The other Asian local currency bond market worth highlighting is the CNH, or the offshore RMB bond market. It is growing very rapidly year to date. The total new issue was up 80% year on year. But this is more localized, and they are mainly dominated by Chinese issuers and investors. Due to China's declining rates, the total return of this market has outperformed the USD bonds this year, despite unattractive spreads. So this market, alongside the Hong Kong dollar market, will continue to grow due to the Chinese regulators' policy directives. And I think the last one I want to mention is the JPY bond market. They're also gaining very strong traction given the large samurai bond issuance by US tech and global banks. It's a favorable market for the regional bank treasury books because of the steep yield curve for them to do some carry. On the audience question of the China property sector and restructuring, I think maybe 3 points to make. The first one is really the restructuring is going nowhere. Most of our clients who have positioned in defaulted China property dollar bonds have written it off. Some of them have been converted into like convertible bonds, but it's very difficult for the pure fixed income real money guys to hold. I would say investor interest in the defaulted guys have significantly declined over the past 2 years. Now it almost becomes irrelevant for most real money investors aside from the fast money hedge fund guys. The second point I want to make is I think the credit contagion risk from the China property sector or the high yield China property sector is very limited as of now. This is because like over the past couple of years, most of the privately owned developers, they have defaulted. So they're basically out of the physical market, they're out of the dollar bond market, and they're not causing a lot of credit disruption. And for the Chinese banks, the government has been giving a lot of policy support forward, and so far their asset quality is still under control. So it's the bottom line is the market is still hovering at a very low level, but in terms of the incremental drag to macroeconomy or the credit contingent risk is quite limited. But then the third one I want to make is right now the China IG and high yield property bond market has become a much smaller one compared with 2 to 3 years ago. And we do still have investors have strong interest in these performing names because they believe ultimately the market needs to have some players, some privately owned players, and these surviving ones are expected to continue to survive and maybe to some extent strive. So for IG investors, we do like state-owned IG high-quality property developers, especially those with some rental incomes from their good quality CRE portfolio and office portfolio. For high-yield players, we also have selected picks for the still non-defaulted names, Greentown being one of them. So still, I think there is alpha opportunities in the sector, and a lot of the Asia high yield bond investors facing the reality is if you want to achieve 9% that type of yield, you will have to dig into the China property sector. And we do feel like based on client conversation, this type of interest is coming back to the market.
Thanks, Zerlina. I'm going to answer quickly a question on Brazil, also probably linking this to Nigeria, even though they're not really linked. But basically, we have elections in Brazil, and someone is asking what's next. Given the trend we have in the election. Well, basically, yes, you have Lula probably in pretty good position. The gap is significant relative to kind of a right-wing challenger, which can be a bit of a concern for the market, given the fact that fiscal consolidation has been very slow, debt is pretty high. Now, I've been market perform on Brazil simply because Brazil in the credit market tends to be quite defensive, and given that I've been not so bold in kind of adding money in this market, Brazil looked quite defensive, considering that external debt is quite small, if not very small. In fact, and effects are high. Now, the biggest concern is not so much political, but more structural. Indeed, we have like a debt level that is high, and it's going to be difficult to bring that lower. But and something that has been kept on the radar a bit is the fact that coverage by FX reserve relative to debt has been declining. And actually, the very reason why Brazil was traditionally trading through the curve relative to other credit peers, that reason is not so much the case anymore. It's more now this kind of debt coverage versus FX reserves is more in line with the market, and I think over time Brazil could face a situation where, or Brazilian bonds could face a situation where they don't have this buffer anymore. So I'm really concerned now. At this stage, I'm still market perform, but with some reservations, for the future. Now, Brazil, something that's been good is the fact that Brazil has become a major producer of oil, has benefited from situation. Just to keep, just as a reference, Brazil produces as much oil as UAE, and this is something that has been not really noticed by many market participants. So obviously, the situation has been favorable for Brazil. Now we have lower oil prices. That makes it a bit more difficult. Now, Brazil is going to be a big player in oil. Just to link to Nigeria, and this is where you see the linkage here, Nigeria is also benefiting from the situation. Now, you had some reforms that have been in place and has been supporting the credit. I tend to think this is going to continue. Growth is going to be quite strong. They announced they're going to tap the market pretty soon. That being said, I think the overall spectrum of high yield is quite expensive. So I tend to be defensive. So again, it's nothing against fundamentals in Nigeria, because I think they're going the right way. But valuations are quite tight in this respect. Now, we're going to move on to probably the top picks and pans. At this point, we're going to be quite brief. I'm going to show the example. So our top picks for unsovereigns is or are Peru, Chile, Colombia. That's in LATAM. The global environment is still favorable for this region. You had significant political shifts in these countries. Colombia is the latest one, and Peru as well, with kind of much more conservative president or government is now in place. I think it's going to be a significant shift in fiscal consolidation in Colombia, even though the fight for kind of increase security measures is going to be costly, but I think Colombia still trades wide. I like, incidentally, countries like Morocco, South Africa. Morocco is really a structural improvement. I expect Morocco probably to gain full investment grade in the coming months. And South Africa, I think there's a strong commitment in fiscal to keep the fiscal under control. So I'm quite confident. Quite cautious still on Philippines and Romania. Philippines growth is a bit under pressure right now, but not so much. It's more like the fiscal that I'm a bit concerned, and even though and knowing that that level is already high, and we have also a situation similar to Brazil where the FX reserve relative to debt has been declining. It's been a strong anchor historically for the Philippines. It's less and less the case now. Romania, I'm not going to be too long, but Romania still face huge challenges. And I think we have the twin deficits that is massive. And I think with political uncertainty, you can potentially have more pressure on spreads. So these are my topics. Zerlina, in a few minutes, what are your topics?
Yeah, so in Asia dollar credits, we still like a little bit boring credit barbell strategy. So we like to position in short-dated defensive credits, such as Korean quasi-sovereigns in the utility sector, large conglomerates such as CK Hutch and New Zealand bank seniors. Meanwhile, we also like to retain some exposure to IG beta, including selected corporate hybrids, Hong Kong bank tier 2s, and Chinese NBFIs. As mentioned earlier, we do see some technical opportunities in Indian financials, particularly the policy and commercial bank seniors and capital instruments, because we think the sell-off due to supply concerns is overdone, and we see very good value for carry. Asia high-yield credits, we see good alpha opportunity in short-dated papers of the highest quality Indian NBFIs, selected China industrial and property names, Philippines non-rated corporate hybrids, and Japanese high yields such as SoftBank and Nissan. We don't like tightly priced Asian banks and financials. This includes the Philippines and South Korean banks.
Okay, Eric, what are your topics and plans, if any?
Yeah, so starting with our LATAM picks, I think the two that I'd highlight are JBS and Vale. JBS and consumer goods, I think the story here is really about demand resilience. Uh, you have an environment where a lot of food companies have struggled with higher input costs and flat volumes, but the protein processors keep benefiting from a strong underlying demand. And JBS has a huge free cash flow cushion over their capex and their interest expenses. So even if feed costs tick up in pork and chicken, leverage there is likely to remain stable. On valuation, we still see value there versus Tyson, which is a higher rated US comp, and we don't necessarily expect JBS to compress all the way to Tyson, but you're paid well to hold it, and that's the carry trade we like. Vale, I think, is another standout over in basics. Here you have a low leverage anchor, a net leverage under 1x, with a healthy operating backdrop that we think compensates you for that EM risk. The China demand question is always the overhang, but management sees the market broadly stable. And on the Iran conflict, they've actually characterized the iron ore supply impact as very well managed. They've hedged most of their fuel and freight exposure, so I think they're insulated from that cost curve shift. And then on relative value, Vale is trading wide to global diversified peers like Tech and Freeport, and roughly in line with Anglo, which we think is attractive given their credit quality. For our LATAM pans, we have Southern Copper and NAP, which are both recent coverage launches. Southern Copper is really important, and there's a nuance I want to be clear about. It's our call there is really driven by valuation, not credit fundamentals. Fundamentally, this is one of the highest quality copper credits out there. They have a very long mine life and large reserves. Net leverage is close to zero. They have strong interest coverage. But then on valuation, the newly issued bonds trade broadly in line with Glencore and Anglo American, despite those names having far more commodity, asset, and geographic diversification. And so this credit screens tied to also Latin copper peers like Codelco and Antofagasta. And so given just how volatile copper and mining credits can be, our analysts who owns that coverage wants to be more, would prefer to have a more attractive entry point before turning more constructive. And now ENAP, being our other pan, we view this as a result of a mix of rich valuations and a specific fundamental headwind. The quarter was solid. In Q1, EBITDA was up on strong diesel crack spreads and a good product mix, but the Chilean government has formally requested ENAP to distribute most of its 2025 net income as a dividend, call it roughly 590 million, and that pushes net leverage back up. On top of that, the bonds also sit near the tight end of their historical trading range versus the Chilean sovereign, so there's very little cushion. And so the break-even math on switching into ENAP just doesn't offer enough compensation, in our view, for the spread widening risk there. So those are our LATAM picks and pans. I wanted to briefly touch, I know we're almost out of time, but there was an interesting question on LATAM corporates with exposure to El Nino. I grew up in Peru facing El Nino alarms every now and then. And, what I would say is that I think LATAM IG is perhaps less exposed to El Nino than the high yield side. I think, most of the riskier high yield names like agricultural producers and Andean hydro producers is probably more exposed on the downside. And that's outside of what we cover at the moment, so that we are building out our coverage pipeline in the region. Our index is heavy on telecom, big oil, Mexican consumers, and those we feel, I think, are likely to weather through the cost inflation and, the limit on the potential crop failure.
Thanks, Eric. I'm going to take one last question. I mean, I'm not going to answer, but there's quite a few, so we're going to follow up with you directly individually. But if any, there's one question saying, what are the drivers that would result in a wider high yield versus IG spreads towards the 300 basis points in the sovereign spread in the sovereign space? I guess risk reward is simply not very attractive. It's difficult to see spreads, compressing much more when there are plenty of reasons where it could widen. Obviously, stars have been aligned so far in a way, despite the fact that there's been a lot of noise coming from the US, but we can't disregard a correction from US equities or elsewhere, stronger dollar. Obviously, this conflict in the Middle East can put further pressure. And you have also potentially coming news from Eastern Europe and Russia. So I would say these levels are repricing kind of like best case scenario systematically, but it's difficult to see much more spread compression. So I would say it's difficult to say which one is going to trigger the repricing. But it's we have had like 3 years and a half already of continuous spread compression. That's already a pure exception statistically by historical standards. So I guess we could have a correction. But I would say my 2 cents guess is probably equity correction, probably first, considering that EM fundamentals are ready to be robust. But who knows? And also, of course, like the situation in the Middle East that can deteriorate or last longer with further pressure on inflation, even though it's not the base case, but that could certainly affect risk reward or risk appetite. I guess we are at the end of this webinar. I'm sorry to not answering all the questions. It's been quite successful in this respect. We're gonna come back to you individually with more answers to your specific questions. In the meantime, I would like to thank the audience for attending this webinar, and see you next time.